Hello and welcome, children, to yet another episode of Money and Banking, where we are giving you the PowerPoint presentation of all the chapters of macroeconomics. Comment macroeconomics in my comment section and press the WhatsApp number that is given on my screen so that you can get the PDF of all the chapters, PowerPoints of macroeconomics, and the 40-mark simulations of all these chapters of macroeconomics along with the MCQs. So here we start with the credit creation or money creation by commercial banks. What is credit creation or money creation by commercial banks? Commercial banks do not print money like RBI, but the commercial banks also help to increase money supply in the economy. And how do they do? The process is called credit creation. So what is the impact of money in the economy? The impact of money in the economy is money has been very successful in separating the business of buying and selling. That means a seller who is selling a commodity is only selling the commodity by taking money. The buyer who is going to the shop or the store is just paying the money and getting the thing. Okay, so buying and selling will never be restricted when money is present. So more buying and selling takes place, greater will be the production, greater will be employment, greater will be GDP generation. So money actually puts the GDP on a very sharp growth track. This is called dynamic function of money. Now let's see how money gets multiplied or credit gets multiplied by the action of the commercial bank in their loan giving process. Let's see. There are three columns I have made. Initial deposit, CRR, I think we should be writing over here LRR, not CRR. Let's write LRR because cash reserve ratio is not the only thing. So LRR, and then we have the actual amount of loan that is being given out by the commercial bank. So let's see. Round one. First, initial deposit of 5,000 has come to the commercial bank. That means some depositor has put it in the saving account. When the depositors deposit their money by opening a saving account in the bank or a time deposit with the bank or fixed deposit with the bank or a current account, then it is called a primary deficit. When a borrower comes to borrow money from the bank, that particular loan is kept in the account opened in the name of the borrower by the bank. That is called secondary deposit. Okay. Now, say a primary deposit of 5,000 has come to the bank initially. What is LRR? LRR means legal reserve ratio. RBI has already commanded the bank that whatever money you receive, do not use up all. Okay, keep some in reserve because for the purpose of if your depositor turns up to withdraw the money in case of any failure situation, never ever give out the entire amount as loan. So keep some amount with yourself also. So now this cash reserve ratio that is being and what percentage of this reserve will be kept, that is also directed by the RBI. The RBI says that keep 10% or 4%. Actually nowadays I believe it is around 4%. I'm not very sure about the exact amount right now. So say it is 10%, remember legal reserve ratio has many other things in it. Not only cash reserve ratio, but also statutory liquidity ratio, some amount of vault cash with the bank, and hence it is legalized by the government. Hence it is known as the legal reserve ratio. Say RBI has asked the government to keep 10% as legal reserve ratio. Now, 5,000 initial deposit, 10% has to be retained. That means 10% of 5,000, 500. So the bank is eligible to give out loan of only 4,500. Now, when it gives out loans, it does not just hand it over like this. They open an account in the name of the borrower and they keep it in that particular account. So 4,500 becomes another deposit in round 2. From this 4,500 again, 10% the banks can give out as loans. 10% the banks have to keep the reserve. So 450 kept as reserve, 4,050 given out as loan. Another person has taken that loan. Okay, say person B. Person A took 4,500, person B took 4,050. Another account gets opened in the name of this borrower B, 4,050. Now from here again, 10% has to be written, 405 rupees has to be written, and 3,645 can be given out as loan to person C. So this process keeps on continuing till we see that there is something called money multiplier, which is 1 by LRR. How much was my LRR? Legal reserve ratio was 10%. So 1 by 10% means 10. 1 by 10% is equal to 10 times. So basically the multiplier value is, money multiplier value is 10. That means whatever initial deposit has come to the bank, ultimately the total deposit the bank created out of this initial deposit of 5,000 is 1 by LRR, that is money multiplier multiplied by initial deposit amount. So money multiplier is 10, initial deposit 5,000. So what is the total deposit created? 10 times of 5,000, that is 50,000. See, the commercial bank successfully has increased the money supply in the economy, or created credit, or created a total deposit generation 10 times the initial amount. And obviously this 10 times or whatever times it is depends upon the legal reserve ratio, as will be fixed by the Reserve Bank of India. Now children, since the value is formula is 1 by LRR, that means you very well understand that lesser the value of LRR or lesser the amount of reserve with the bank, greater will be the credit creation. Also, jitna initial deposit zyada hoga, because it is directly proportional multiplied by initial deposit, the greater the value of initial deposit, more will be the credit creation. And that is the reason why now you can justify why Jan Dhan Yojana was made. More and more people putting their deposits in the bank, more deposit mobilization can be done by the bank. Okay. Now in this particular regard, ये जो पूरा मैंने कहा ना, ये पूरा जो situation है, इसमें कुछ assumptions है. Like, number one, the entire banking system with its branches is known as bank. It is not happening to only one bank or one depositor or one borrower. It is happening to the totality of the banking system in the country. Thousands of depositors, thousands of borrowers. Okay. Number two, the Reserve Bank of India says that you have to keep a minimum reserve, which is called the cash reserve ratio. Also, the bank has some statutory liquidity ratio. That means, you know, some cash incumbent deposits, okay, securities. And number three, the banks also have some vault cash of their own. So all three are legalized. So it is called the legal reserve ratio. Okay. Number three, the banks, you know, they do not give out all the loans. They will be keeping some reserve as told by the, or as assigned by the RBI, known as the legal reserve ratio. So number three, we have to remember that, you know, any prudent banker knows that all the people will not turn up to take their deposits out at a time. And also number four, they also know that, you know, there will be a constant flow of deposits, primary deposits in the bank, as will be the flow of loans being given out from the bank. So all these assumptions together gives the scenario of this credit creation system. And also remember, higher and higher the credit creation in the bank, greater will be the money in the hands of the people through loans, and as a result, greater will be their purchasing power, greater will be the aggregate demand of goods and services in the economy, greater will be the production of goods and services as a result. So higher will be the level of employment, higher will be the level of GDP. So this entire credit creation has a direct impact of dynamic function of money in increasing the gross domestic product of the economy, or bringing about economic growth. Now in my next episode, I will be talking about the Reserve Bank of India, or the Apex Bank, which is responsible for controlling this entire monetary system of banks and financial institutions.